see the color of your soul. The color of your soul. I can see the I can see the I can see the color of your soul.
Secrets create barriers between people. Speaking from experience, believe me. All that you've done, it's a part of you. It's a part of you. Secrets.
Just don't want the cry. You can take the pain. You can take the pain. Take it. One more time. One more time.
Good morning, folks. Happy Taco Tuesday to all those that celebrate this momentous occasion. We're just about to get this stream going. Hope everyone out there is ready for a jam-packed session, and they have some symbols for chart requests and questions and otherwise. We're gonna have some fun here. I think it'll be interesting. It's not an amazing market environment if you're bullish, but there's always two sides to every opportunity, and there's been a lot of interesting breakdowns happening underneath the surface in this market. I just highlighted a chart of the Russell 2000 on my Twitter feed that is trading well below its 200-day moving average and not even really looking back. It's pretty interesting. We've got some big stocks down heavy this morning. Nvidia down about 4%, Tesla down about 4.21%. MicroStrategy, a favorite high beta trader, down 3.67% as the company renames itself to Strategy. That's what I call it. It's really tragedy, right? But they did rename themselves to Strategy. All right, so let's dive into Back to the Futures. I think it'll be an interesting, volatile day. We're deep in negative gamma territory here, so lots of opportunities for volatility to kind of come out and rear its ugly head a little bit more in this environment, particularly as we approach quarterly OPEX. So let's quickly talk about a few things before we dive in to Bookmap. And again, folks, if you have questions, let me know. I will be checking on things as we go. So the folks at Bookmap would love for you to join their Discord. That's discord.com/invite/bookmap. And there's regular events, including mine, every Tuesday at 9 a.m. Eastern. You can find education, you can find support. There's a great community of folks there. So it's a great Discord to check out and get to know. And there's about 3.75 thousand folks on there right now. About me, well, I'm aging myself here, but I've been trading for about 20 years. And I really have, I don't know that there would be anything else that would provide such a fascinating journey into the center of so many different elements. We're talking about finance, obviously, but there's so much interconnectivity with the economy, with society, with businesses of various industries, and learning more about how they work so you can try to find the ones you want to invest in, as well as the sectors and industries that are benefiting from those bigger picture tailwinds that can be coming on, and vice versa. Identifying how some of those headwinds may be impacting areas where it's time to de-risk. And I would say big tech is definitely one of them, something I've been talking about for most of this year, that I felt it was going to underperform the broader market, and it truly has. So what I really do is I look at the big picture, I look at flows, I look at options positioning, I look at some of the intermarket dynamics, and I try to identify opportunities on various timelines to take advantage, as well as risks of areas where it may be best avoided, or even where there may be opportunities to fade some of these things, either in straight up betting against price like shorts or puts, or pair trades, where you're pairing relative strength versus relative weakness and capturing that delta in the middle. So my approach has become more systematic over time, and there's a really important reason for that. I find that when we look at really a lot of the ways that markets move, it's really important not to let our emotions get the best of us. Typically, when a market is getting closer to an inflection point, it's going to feel like it can do no wrong, that everything is as good as it's ever going to get, that there's really no downside risk. And you even hear it and see it. Interaction with friends, looking on social media, and otherwise, you see more and more people getting emboldened that, oh no, the market can only go up. There is no risk. There is no reason to be bearish of anything. And I also feel like there's this sort of attitude of ostracizing anyone who's concerned about risk as if they're a bear. And the reality is, risk management is a key to survival. So having that little bearish voice and that little bullish voice, and sort of like the devil and the angel on our shoulders, That's really important to managing our outcomes, right? But what's even more important than leaning into our gut feel is letting data take the driver's seat, building approaches that are more systematic in nature. I think that's one of the most important things that we can do as traders and investors. And I started off as a much more discretionary trader, but my approach evolved to be more and more systematic over time because I was logging my trades and I was figuring out what's working and what's not working. Right. And what I was finding out is more and more of my data driven trades and investments were having a much better performance and a much better win rate than a lot of the discretionary stuff. Now, to each their own, we're all wired differently. So, what works for me may not be the best approach for you, but I mention this in hopes of inspiring you to kind of look within and figure out what does work for me. Journal your trades. Why are you entering? When are you entering? How, in terms of your size? You going all in? You going in quarters or thirds and scaling in? You know, those are important factors, as well as what's motivating you. Is there an emotional component here? Is there a chart setup? Is there a fundamental or macro driver? Is it a confluence? All of that really matters. So I just mentioned that in hopes of drawing from my experience to help you accelerate your own journey as a trader and as an investor. Well, let's talk a little bit about why I watch order flow as well. We could see a little bit of the book map, heat map in the background here, a prelude for what's to come. So for me, order flow analysis is a really interesting way to drill down, especially in the intraday, to find opportunities. You can find different opportunities depending on the type of environment you're in. If you're in a market that's more in balance, you're looking more for these mean reversion types of trades, right? There's usually somewhat of a top and a bottom of the range. You can help to define that by looking at the volume profile, by looking at the price action, the options positioning, and then you can trade that range, right? And then if you're a trending market environment, particularly intraday, but also on a swing basis, you're more likely to see a market that moves. For example, upward trending, you're just in very simple terms, seeing a market that's moving from the lower left to the upper right of your chart, and the opposite in a downward trending environment. Now, on an intraday basis, we're validating trend based on setting a high and a low and looking for the market to make a meaningful move above or below those levels and continue that move. And then we define that also by looking at the prevailing flow, particularly in options, and seeing if it provides a catalyst for that trend to continue on the basis of the flow. In those environments, it's a little bit easier to look at that flow, as well as the volume profile and price action, to find where there are opportune times to exit and enter that market, right? And where those levels may be. Now, looking at order flow to help with that process, one of the places I'll look are what we call deltas. So you have several areas where deltas are going to emerge. One is the session volume profile. When you're looking at the session volume profile, that's the net volume on either side of the trade, the buy side and the sell side, that's happened at a certain price for that trading session. For me, I start it in the overnight at 6 p.m. Eastern, right? So as soon as Globex opens, I'm building my session volume profile that I will reference throughout even regular trading hours. And that session volume profile is likely to evolve during regular trading hours for the S&P 500 because that's where most of the volume is going to transact. Now, why am I looking at the deltas? Because it can show you where buyers and sellers may become a little bit more aggressive and where they may be also offsides if price moves against them. So for example, if you see an 1,000 sell delta on the S&P and price is getting 5, 10 handles above it, you have to imagine a lot of those sellers are getting nervous if they entered short there, right? Not everyone entered short there. We're going to make some inferences about their positioning, but we have to imagine some did. And as price moves higher in this theoretical scenario, those folks are getting more offsides. They're likely to get more nervous and become motivated buyers, right? Who has to be a motivated buyer? Certainly no one on the sidelines has to be a motivated buyer. But if you're a short and price is going against you, you have to become a motivated buyer at a certain point. And the same is true of longs that get offsides. If you see a big delta in the session volume profile, let's say 1,000 on the buy side, price is moving further and further below it, 5, 10, 15 handles, those folks become motivated sellers over time because there's only so much pain they're able to handle that their risk management will allow for. And eventually they have to exit those positions. So that's one area to look at deltas in the session volume profile. And that's why, because you get a sense as to where folks may get a little more sensitive to the price action. Another area to look for deltas is in the transactional activity itself, right? So if you're looking at Bookmap and you see the bubbles on screen, you can kind of see them in the background here, and we'll see them soon when we go live. Those represent buy and sell deltas, right? So really large red bubble, really large sell delta, really large green bubble, really large buy delta. That's important because you can see that aggression playing out in time. The session volume shows you aggression by price. The volume bubbles give you a sense as to what's happening right in that moment at a certain price and a certain time. So that can be a little bit more near-term actionable. Whereas the session volume profile can give you some places where you sort of draw a line in the sand and look for a reaction that may happen. So those are two ways to analyze deltas. Bookmap also lets you put those deltas in the volume that you have on the bottom of the screen. If you want to have those volume bars, you can set those up as deltas as well. So those are three easy ways to look at deltas in order flow analysis. There are other kinds of deltas to look at that we'll talk about during subsequent sessions, but I wanted to give you all just a quick primer because we're likely to reference some of this as we get into the session. Another thing that I really like to look at, and Bookmap makes it very easy to look at, is icebergs. Now, there's a lot of ways that people infer icebergs, but there's only one real type of iceberg, right? So I know some folks will look at volume profile and say, oh, that looks like an iceberg because we got this really big block of orders here. It may not be the case. What's nice about Bookmap and Rhythmic and Bookmap's own data as well is the MBO data actually lets you identify iceberg and stop orders. So when those orders are placed on the exchange for futures, you can see them playing out in their size at the prices that it's happening. And you can even chart it on the subchart to see which type of order flow is becoming a little bit more excited when you have a pickup in action in the market. Why does this matter? Because icebergs can be pretty important. If you think about what an iceberg is, it's essentially someone not showing their full hand. So if I have 10,000 contracts of S&P to move, I'm not going to show that in the order book because it's going to freak people out as a limit order. That's an enormous limit order. But I might parcel it out, right? Maybe I parcel it out in 500 contract lots. And maybe I try to do 20 of them over the course of several hours. So that way I'm only showing a 500 limit order on the order book. And as a result, it doesn't tend to scare price quite as much. I'm able to get better fills, right? That's the idea behind an iceberg. The disadvantage, of course, is once your order gets filled, you're sort of back of the queue for how those orders are executed. So if you're a retail trader and you're thinking, boy, I'm going to use icebergs, that sounds like a really smart move. Just be aware the other side of it is that it does deprioritize your execution. After that first lot, you're back of the queue, and then you got to wait to get back up there again. So if it's not something that's super liquid, it can delay the execution. It's not as big of a deal in the S&P typically. Now, why do icebergs matter when we're watching futures? Because if you see enough of them happening at a specific price level, it can give you a sense that we may be marking a turning point, or at least an area where things start to potentially cap out. For example, if you had a really exhaustive run higher, you have a big move in a short span of time, and a lot of the shorts are getting stopped out, and you see that exhaustive stop out action that's happening with, let's say hundreds and hundreds of stop outs happening. And then on the other side, you see icebergs selling into those buy stops by the thousands. That can mark a potential reversal, or at least a point where the market's going to stall out. So looking for that large passive order flow is also important. And what I like about the MBO data and the way Bookmap visualizes it is, in no uncertain terms, you know exactly what you're seeing on screen. That's an advantage. And, being able to see that for us little guys, us retail traders that are little fish swimming in a sea full of whales and sharks, that can let us know where those bigger desks are executing. Then exhaustive trading action. I talked about one version of that with the big stop run. Another one is where you see just an enormous chunk of volume come in, a big wick, and then price starts to move lower, right? So I've built an indicator that can also systematically help to identify those. It's the exhaustion indicator. We have that available on our Discord for some of the major futures contracts like the S&P, the NASDAQ, crude oil, etc. Excuse me. And that can be helpful as well because it generates an audio alert and a visual alert, so you're not necessarily just having to watch the screen. Similar for icebergs and stops on Bookmap, you can generate audio alerts, right? So that can be helpful if you have something of sufficient size to draw your attention to the screen. Now, why do I use Bookmap? I've talked about some of the reasons, but let's go over it just a little bit more in summary. The visualization capabilities are awesome. That's what I was just talking about with seeing the deltas, with seeing the icebergs and the stops, having all that data on one screen. I don't know about you, but even though I have a lot of monitors, I don't want tons of charts. I really want to keep it super simple because some of my other monitors are for research, for execution, for keeping in touch with people, for, basically like having different workflows. So it's not all just charts and trading. And having that simplification, anyone who's been doing this long enough will tell you it makes sense to optimize your process so that you can make decisions quickly with the right amount of signal. Too much information can cause analysis paralysis. Too little information can cause us to go by our guts too much and kind of blow ourselves up on the basis of emotion. So it's about finding a balance. And that's why I like the way that we're combining this key data on one screen, because I can have Bookmap, then I can have a longer time frame charting system like MotiveWave or TrendSpider, marry the two, and I'm able to see all of the price action and all the other data that I really want to see. And then it's easy to layer on new features, which I like a lot personally, because I built indicators for Bookmap and I've been able to demonstrate to myself and to, folks that use those indicators at Traderade how valuable they can be in identifying some of these trading setups. That again, it's systematic. I'm defining situations that may be exhaustion, absorption, flows and options and key levels that exist in S&P options, and using that to define where there may be actionable levels. So I know a lot of the time we'll spend a lot of time charting, identifying these key levels, and then using that in our process, and that's fine. But imagine automating that to the best of your ability to identify some of those key levels and then saving a lot of that mental capital so that you can use it when you're actually trading. That's what I'm all about. And I encourage other traders to consider a similar approach because really we should optimize our time and our energy for execution. Now, today's pivot level that I'm going to be watching is S&P 5814.25. This is one of the pivots that my dynamic pivots analysis algorithm has identified as a key pivot on a swing time frame. And we're just trading around it this morning. In fact, we bottomed just around it earlier. This is also not too far above 5,800, which is a large options level on SPX, right? So we have two areas to watch to offer some support. Now, if we're able to make a meaningful bounce from this pivot, we might get some scalpable longs. I don't think we're out of the woods yet with this corrective episode we're having. I remarked yesterday I didn't think we were oversold yet by several of the indicators I looked at, so I'm not too surprised to see some continuation this morning. But what I will say is this is a level that previously the market has told us is important. I still think it's important in today's tape, and some of the pre-market action confirms that. So ES 5814.25. That's a level to watch for today's trade. I'm just going to put that out on social real quick. And then we're going to get into some of the options analysis for the S&P 500 options chain here. We are deep in negative gamma territory. So this is something to pay attention to as well because it affects the trading environment quite a bit, right? That's something to take into consideration. And that impact is generally catalyzing additional volatility. So if you're in a negative gamma environment, what that tends to do is it tends to reinforce this idea that the way dealers are hedging is selling dips and buying rips, which of course is going to add to intraday realized volatility. It doesn't necessarily give you a clear sense as to whether it's going to be up or down volatility, right? Volatility cuts in both directions. And I say that because just as an aside, a lot of the times when people say, "Oh, vol's going to pick up," the inference is, "Oh, the market has to go down." It's not necessarily that way. This type of volatility cuts in both directions. Now, if you do zoom out on a swing time frame, negative gamma tends to be more bearish, positive gamma tends to be more bullish if you just look at the impact on price discovery on longer time frames. But intraday, net, it tends to amplify volatility in both directions. So what does that mean for us as traders? It means smaller size, wider stops, right? If you know vol is going to be magnified, then you can downsize your position if you want to participate so that you can accommodate a larger stop. That means you're still taking the same amount of risk because you know the market's going to move more so that you don't just get stopped out on both sides of your trade. Now let's talk about some of the exclusive deals that we have going on right now. If you're interested in checking out Bookmap, and I welcome you to watch this stream because I think you'll learn a lot and maybe you'll want to check it out, bookmark this for later. Traderade.com/bookmap. It'll take you to their website, and if you scroll down, there's a special offer for the quarterly and the yearly plan that will give you up to 40% off, which is a pretty awesome way to get started. If you're interested in checking out more about what we're doing at Traderade with our cutting-edge trading tools, our actionable ideas, and educational resources, and of course our awesome community, you can get up to 20% off Traderade using the code Mayhem20 at checkout. Just visit Traderade.com to learn more. Now we're going to dive right in to Bookmap here. And I know there's folks that are watching NVIDIA this morning. This one's been on everyone's mind because it's really had a pretty nasty drawdown. We're just going to bring this to the overnight session. We can see we're trading 109.58. And this is a stock that's, I think some of the narrative has seen a near-term inflection point. There's a bit of a plateau that's been built. And because the AI narrative is really hinged on this company being a leader, a lot of the other AI peripheral stocks are also selling down in sympathy. So it's something to take into consideration. It doesn't mean the whole story behind NVIDIA is over. It does mean, however, there are some serious challenges ahead. And I think the last conference call spoke to that. And I did make some commentary after that call wrapped up. It's on my YouTube, but I essentially just didn't feel like the tailwinds were quite as powerful for this company. I think their margin compression is a real concern. And I think what's happening with AI inference and training becoming much more efficient, much less computationally intensive, is another headwind, as is the potential of this trade war causing some more scrutiny of NVIDIA's anti-competitive monopolistic behavior. And then finally, specialized chips for training and inference that could take away NVIDIA's staggering 95% market share in the data center. So I'm going to just quickly get to a question here, and then we're going to continue. We're just about 6.5 minutes away from the start of trading today. Street Salsa asks, we can't get open interest of futures market in real time, can we? I believe that information is updated day by day on CME. So that would be where you'd probably want to check on that. And then they have the COT reports that are updated weekly. So those are probably the best two resources, but Quick Strike on CME has great information and it's free. So that would be one place I would check just for a variety of different tools, including being able to look at market depth as well. It's a pretty handy place to check out. All right, so let's get to some of the other areas of the market that are worth looking at as we approach the trading day. We've got MicroStrategy here as well. This one has been under pressure. Yesterday, it started off strong and then reversed. And we saw crypto reverse as well. That stock closed down just about 2% yesterday. It's down another 4% this morning as we see crypto reversing those gains that were from the weekend. The idea that the United States is going to be building a strategic crypto reserve, which I have to be honest, I don't really feel like that's going to be a big bullish catalyst for this space. And I think that we're starting to see some of that being realized. And of course, one thing to consider is the namesake meme coin of this country's president was rug pulled before his inauguration. So that might be an area to consider looking back on as to how much trust we can place in some of these initiatives. Just my 2 cents. Let's take a look at the S&P 500 futures here. We're going to look at that filtered view using TraderMap Pro, and we're just zooming out from the overnight session. You can see we're pretty much flat. As we approach the US Open, we saw a pretty big wave of selling, and this had a lot to do with Treasury Secretary Bessent coming out and really talking a bit more about what we can expect from some of this trade warring that is picking up. So something to just take into consideration going into today's tape. U.S. Treasury Secretary Bessent was saying quite a lot about China. China's export model is not acceptable. Export manufacturers in China will have to eat the tariffs. Of course, China put a 15% tariff on U.S. imports as a retaliatory measure after the U.S. was saying they didn't expect much retaliation from China. Now, China imports a lot less from the U.S. than the U.S. imports from China, so these tariffs do have a bit of an asymmetrical impact, really catalyzing the potential for importing some more inflation into U.S. manufacturing, right? As well as some of the goods that are just directly coming from China. You could think about computers, you could think about phones, circuitry, some of the semiconductors they manufacture. There is more of that potential for inflation to be passed on to the end consumer for industries that are not able to directly eat that tariff in their margin, or they have the pricing power to not eat that tariff in their margin. Now, coming into today's trading day, we do have just a couple of different things to pay attention to. Let me quickly pull up my calendar. We've got the Economic Optimism Index coming out at 10 a.m. We've got a Fed speaker at 2:20, Williams. And then later, after the trading day wraps up, and let's just take a look a little bit later. We do also have this evening an announcement by President Trump on tariffs at 9 p.m. So that could be an overnight volatility catalyst. And then finally, we also have Costco and Broadcom reporting earnings later this week on March 6th. So something else just to keep in mind, since those are some pretty well followed companies. And we're just less than 2 minutes away from the market open here. So I've got a request for crude oil, and we've rolled that contract over. So let me just go ahead and get that plugged in and make sure I customize it with my settings. And as the market's opening, we are seeing a bit of a sell down here. And just give me a second as I pull some chart settings. And that is, let's see, that was not the contract I was hoping for. One moment. All right. There we go. So the question is, can I look at crude and what's the benefit of stop runs and absorption and exhaustion when it comes to making a trading decision? That's a great question. So the biggest thing that I think adds to a benefit of looking at stop runs is trying to find where we're basically getting ahead of ourselves, where the market is, maybe seeing a point where one party got completely knocked out of their trade, and now we may see things sort of revert back or take the other side of it, especially if you see icebergs taking the other side of that trade. I feel like that convergence that I talked about as we were introducing today's session was pretty important. Absorption and exhaustion are worth looking at because absorption allows you to see when one side is getting more eager about absorbing the price action and the flow of another side. So, for example, you may see aggressive absorption in crude oil that coincides with a bottom being put in. So, let's say you have a big drawdown, buyers start to aggressively absorb uh, contracts, and then you start to put in a bottom. That can be an absorption event that, if it's large enough, can lead to a reversal. Similar, an exhaustion event can be the other side of that. Let's say buyers get way too excited, they push a really large spike of volume, they start to get offside, smacking the ask. That can lead to an exhaustion event when there's that much sort of sweeping activity happening. And often is the case, that can mark a near-term top or even a potential reversal area. So for me, looking at those events, whatever the contract may be, can be helpful for very short-term trading decisions, intraday trading decisions. Now, zooming out a bit on crude, I'm just going to use USO as a proxy here on TrendSpider. It does look like we're just in a really big balance range here, and we have been for months and months. So I don't really find much reason to get too excited about upside here. It feels like The bearish side of the trade is taking control. We're getting pulled back into that point of control on this chart, that really high volume node. And we're just sort of in this balancing range. I'm a little bit more bullish on energy companies than oil itself, where we've seen just a little bit of relative strength in energy companies versus oil. If you kind of cross compare the charts, but you could see XLE is starting to catch down a bit here. So overall, I think crude is probably going to be a bit choppy from a technical standpoint. We just been sort of balancing in a range for, really actually at this point, well over a year, about a year and a half. The other side of it that concerns me about oil, if we look at the macro picture, is that OPEC Plus has said that they're going to start pumping more oil. This is in a market that's already arguably a bit oversupplied. And if Chinese stimulus doesn't come in kind of heavy, and they're one of the largest energy consumers in the world, then that creates another set of issues, right? Basically, if Chinese stimulus doesn't come in heavy, then one of the larger oil consumers that's been inferred to start to pick up demand may not pick up demand. So that's something else to take into consideration. Just what may happen with some of that oil consumption and that trend if China doesn't come in with OPEC Plus pumping. The other side of it is what Donald Trump did by pressuring OPEC Plus to be the source of greater supply in an already oversupplied market isn't necessarily good for U.S. oil companies because, ordinarily, and the political mantra was drill, 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 you might see that supply come on from U.S. companies, especially at higher prices. But if now we're seeing that supply come on from OPEC, which, to them, they're able to add to supply a little bit more quickly than we are, because we need to bring more resources online that can take months, whereas with them, they can pretty much start ramping up existing production capacity. So that means that U.S. drillers are less likely to benefit and less likely to expand capacity into what they see as an oversupplied market with less than advantageous prices. So I think for crude, this discount we're seeing is logical, and the volatility we're seeing also makes sense. And unfortunately, it's probably something we're going to have to get more used to if this oversupplied environment continues. The Chinese NPC meeting, which apparently doesn't stand for non-player character, National People's Congress, but their meeting starts tomorrow. So if we're going to hear some talk about greater demand for energy, probably going to be something that we start hearing about as early as tomorrow. That would be the bullish catalyst for crude if we're going to get one. And I wouldn't necessarily hang my hat on it because China's been promising pretty large stimulus for years now, and we've seen very little of that fulfilled. So for now, cautious on crude, looking for it to continue to chop in that trading range, and path of least resistance for the moment seems to be lower, and really looking for some kind of catalyst on the demand side to change that. So let me know if that's helpful on the crude front. Got some other questions coming in. I'm just going to get to those real quick here. Hello, teacher. In your opinion, do you think that some of the pricing has already been priced into the markets based on the new tariffs? I think some of it has, sure. But the problem is it's an evolving situation, and policy clarity from this administration has been a challenge. There's been a lot of things said. Now we're starting to see things being done. And that's when the rubber really hits the road. So we've got these first wave of tariffs coming on. We've got another wave of tariffs set to start, I believe, on April 2nd for Europe and for some of these other areas, the reciprocal tariffs, as they're being called. We don't know what this necessarily portends to, because going into this, the market was assuming this is a negotiating strategy, and Trump's just going to play hardball to try to get more favorable trade terms. And the reality has become that negotiating strategy isn't efficacious. It's not compelling the sort of outcomes that maybe want to be seen. And this administration is serious about putting these tariffs into play. Now, how are they priced in? I think that all depends on what the end impact is. How many of these tariffs are eaten up by the manufacturers to remain competitive? How many of them are eaten up by the companies that import these products if they don't have the pricing power, but they have the margin to absorb them and they don't want to lose revenue? And how much is it passed on to the end consumer? If these tariffs start to cause let's say, a pullback in overall demand, but also higher prices, sort of that stagflationary impact of slowing economic activity, but higher inflation, then I would say it's not really priced in yet. That outcome is something that would be jarring to the market, and it's still a tail risk we do have to be considerate about. The idea that tariffs could cause some pass-through inflation and also some reduce in overall economic demand. So let me know if that was helpful for your question, Ships. Mike Smith asks, greetings, the yellow and green indicator, what are these? Are we talking about the lines below price on crude oil right now, Mike? Because there's a few different indicators on screen. So let me know if that's what you're asking about. I just want to make sure I answer the right question. But this line here is the point of control, and this is the lower end of the price range for extended hours trading, which will reset. Actually, no, this is the lower end of the price range for regular hours trading right now, because that resets at 9:30 a.m. So let's get to the markets here. S&P 500 under pressure. We're going to zoom in. And we can see there are some pretty sizable offers overhead here. 58.45, 58.50. This is some interest in higher prices that we're seeing from the market, as well as 58.25, just around yesterday's warm put and the Gamma 2 level. That's the second largest level of gross gamma positioning. You can also see these sort of brackets around price right here, very close to some of the negative key deltas that we have in the options chain for the S&P 500. This is the 6th largest negative delta and the 7th largest negative delta. That's where there's put positioning that is large and worth noting that is in excess of call positioning, right? So there's some confluence there. And shortly we will see some of the flow for today's price action for the S&P 500 options complex start to print as well in the SPX options visualizer. But what we can see here is right now we're sort of trading in this range between these two large liquidity levels at 5,800 and 5,825. And we're starting to see some of that refactoring of those interest levels, right? So we're going to start to see the volume coming in minutes now for some of the more active levels. But these SPX options visualizer levels, they get recalculated every minute during the trading day. So it's a pretty helpful tool, as options are the largest influence on price by far. It's about 1.2 trillion of notional that trades in the S&P 500. And that significantly dwarfs the amount of notional that trades in futures, which is about 400 to 500 billion on the daily. And with S&P 500 options, about half of that is 0 DTE. About 75% of that is for options that expire in about a week or less. So we could see price continuing to drift lower, now taking out that bid at key 7 and continue to push lower. Bit of a stop out event, 208 stop contracts on that new low. You can see the green line, that price line, that lowest price getting pulled lower here. So if you're looking at this on the basis of, say, a 5 or 10 minute opening range, we're starting to break below that. I do favor the 20-minute opening range, but some of these shorter term opening range traders starting to see some push below, making a new low. We'll have to see if we build some acceptance here in this new lower price range. We are also below that key pivot level that I was talking about before the trading day started, around 58.1425. So again, leaning more bearish below that pivot level and below some of that larger positioning that was around SPX 5800 that is now rolling lower. As we can see, the vol trigger and put wall now rolling lower in this price action. Let's take a look at some of the other areas of the market with the mega caps on screen. We've got Apple just trading in a bit of a narrow range after the open. Lots and lots of offers stacked overhead here. And let's just make sure that we can pull in this outside liquidity. So we could see just an enormous delta between bids and offers, about 1.5 million in excess on the offer side than the bids. So there's just a lot of supply overhead on Apple. Similarly on Amazon, lots of supply overhead. This stock opened up, made a new low, had a quick bounce above the point of control, and then right back to that low here. But again, just lots of supply, 1.7 million of offers versus bids on Amazon. Broadcom, a similar look as well. Lots of supply, opened up, kind of pushed lower right off the open. So some selling pressure just adding into some of these majors. Costco kind of all over the map. Not a very liquid trader, but this one actually has more demand. A delta of about 120,000 on Costco. And then Alphabet, another story of more supply than demand. Not quite as much as the others, though. Delta about 336,000. And this one opened up with a bit of pep, actually pushing higher off the open. JP Morgan selling down. Pretty nasty open for this one. Just selling down off the open, making new lows. And this is a stock where bids and offers are relatively well matched, but we are seeing some headwinds in finance here. Meta also stair-stepping lower off the open, actually has a decent amount of demand here, really starting at 630. So watch that level for potential support. Microsoft making new highs off the open, although there are a lot of offers. So look at 388 to 390 for potential resistance on that one near term. MicroStrategy getting a bit of a pop off the open. Lots of supply overhead, a delta of about 970,000, with some of those bigger offers coming in a lot higher than here, but around 295 for one of the bigger offers on that, and then 260 for still a noteworthy smaller offer of 5,670 shares overhead. And NVIDIA coming down off the open as well. Let's just zoom this in a little bit. So we saw a bit of a drop, now starting to come back on with some buying pressure, pushing the stock to new highs on the regular trading hour session, then backing off and then pushing back into that 114 level. Seems like there's a decent amount of support below on this company, starting at around 110, where there's 813,000 shares on bid. If we go out and zoom out just a little bit more, you can see there's a really large offer at 140 with about 1.3 million shares on offer. But I would look for some resistance on this thing around 120, 125 with those offers. And remember, a lot of supply overhead like this and the others, 19 million delta, 28 million on offer versus 8.8 million on bid for NVIDIA. And Tesla is another one where there's a lot of supply overhead, but right below price, there could be some decent support. 270's got 140,000 on bid, 260, 104,000 on bid. So just around price, there are a decent amount of bids that could support this stock a bit, could create a little bit of demand. And we'll take a look at the NASDAQ here. NASDAQ seems to be trading in a range overall since this open. That high just around 2430 and that low just around 2260. And got a few more questions coming in here. Let me go ahead and get to these. All right, one question coming in from Ships. What do I think of Meta here? Let's bring it on screen. We'll start off with a weekly chart. Weekly chart still looks pretty constructive overall. You know, the pullback still looks pretty measured and orderly. I would get a little more concerned if we challenge the 21-week moving average and close the week below it. Momentum is fading. We could see that in the histogram below, but let's zoom into the daily. It definitely looks less ideal there. We can see that sellers are taking control of that near-term momentum. The histograms flipped clearly into negative momentum. You see this low volume node here. We're pushing below it. These tend to be areas of decision. You can see previously this was an area of resistance, and then we just popped right above it, right? A really powerful impulse move higher, and now we're fading. We're also in the Ichimoku cloud on this daily chart, which would suggest we're trendless, right? So not necessarily by Ichimoku theory, or we're right above the cloud, I should say. So we're still in an uptrend even on the daily based on Ichimoku cloud theory. Sorry, it's kind of dark on my screen, so I was having a hard time seeing it. But if we cross into that cloud, we become trendless. If we cross below that cloud by Ichimoku cloud theory, you're in a downtrend. I don't like seeing it below the 21-day EMA, and you can see how important it is as we've rejected clearly there twice so far, like a pop above, reject right at the 21. And as we rejected the first time, you could see selling momentum picked up. So that would be something that maybe you want to plot out. Look at that 21-day EMA on your screen. Look at the MACD histogram, how it's rolling lower. And we're clearly in negative territory for momentum on the daily. Also, looking at the volume profile, you can really see it's pushing below a key low volume node. If you close like this, it suggests we're going to get pulled into this high volume node where we could consolidate for a while, where we had previously also consolidated for some time. All that would be healthy. I mean, this is a company where I think the price action has gotten ahead of the reality, where the narrative has been very exciting, but not necessarily incredibly realistic. And what I mean is, you know, there's a lot of talk about AI capex and how eventually that's going to return this huge return for investors on their, you know, on the spend that Meta is doing. There's no certainty of that. And there's more and more competition coming online that's really challenging Meta's Llama models, like DeepSeek, like Alibaba's Qwen, like Claude, like OpenAI, like a lot of the other companies are also putting out powerful models. So Meta doesn't have an edge here. They have a monopoly in social media. They have a near monopoly in advertising, sort of a duopoly with Google, but in AI, they don't have that edge. So it's a totally different space for this company. And I think that is to some degree catching up with them now that some of the tailwinds for the AI narrative are coming out as well. And you can see that with NVIDIA, you can see that with Meta, you can see it with some of the other AI leadership stocks like Palantir, all kind of coming out of favor. So for now, I think this thing is challenged, and I would look for it to probably, if we close today below this low volume node, I'd look for it to probably be pulled down deeper into this next higher volume node. So you might start to see some support coming in during, you know, areas where we're retesting some of the tops of the prior consolidation zone. Maybe around $600 could be one area of support you could see, and then the bottom of that prior consolidation zone around 585. And then finally, the bottom of the even earlier consolidation zone at the bottom of this node around 555, 560. Those would be some of the levels I'd watch on Meta. Again, if this pullback below this low volume node continues, if we're able to stage a rally from here and actually close above that volume node, I look for this thing to try to re-challenge the 21-day EMA again from below. So that's my sort of looking at both sides of the trade on Meta based on how we treat the low volume node we're in now. Hopefully that's helpful for you, Ships. Then I've got someone asking for gold. Let's see what we can do about that. We're going to start off with the GLD on the weekly. And look, on the weekly chart, it's still a very healthy uptrend. I don't have any tremendous level of concern about that. You could see that it's respected the 21-week moving average repeatedly throughout this rally, so we know that's a key level. I would get more concerned if it closed the week below it. Right now, we're above the cloud, we're above that 21-week moving average, and gold's experienced a healthy pullback, which we needed to flush out some of the, really, really speculative positioning in gold. And now we're starting to resume that uptrend. And the best part is we're resuming it with money coming out of other places in the market. So gold is being seen to some degree as a safe haven. You're seeing a bit of a rotation. I know some folks have said, oh, if the stock market corrects, gold has to go down too. It's not always the case. There are times where gold is sought after as a safe haven, and I believe this is one of those times. The uncertainty is sort of the key thing that gold is helping you hedge against as a trader, right? It's a hedge against uncertainty. I think that's one of the most important things to consider about gold. It's not really a hedge against inflation, in my opinion. It's much more about uncertainty. So as geopolitical certainty, as domestic policy uncertainty, as tariff uncertainty all sort of increases, you could expect gold should continue to get a bid. What concerns me the most about gold here is just that overall, it's still a bit lopsided to the long side. So it wouldn't be tremendously surprising to see some kind of correction. But for now, I think the path of least resistance is higher to about $3,000 an ounce. And then I would expect some consolidation or maybe a correction to take place. So that's kind of my view on gold over the longer term. Let's zoom in a little bit to the book map view of gold here. And we'll just take it out to the European session. You had that nice pop for the European session, really pushed gold all the way up to about 2038. And then you started to see a little bit more passive selling coming into gold. And, now you can see it's starting to roll over a bit here. So for the near term, again, I expect gold to be a bit choppy, but I do expect the path of least resistance to be higher to about $3,000 an ounce. And, looking at the relative strength today with the U.S. markets getting sold down and gold still catching a bid, that rotation does seem to be underway. So that's healthy. That's something that we really do want to see. And as long as gold's able to continue that relative strength, I think there's no reason it can't move higher here. The dollar's down as well. That gives gold a bit of a boost. You can see the dollar really rolling over. That's another area where positioning was even more extended than gold in the long dollar trade. They had gotten ridiculously extended. So the dollar could continue to roll over. That would add a tailwind to gold. You're also seeing a pretty big bid in the long end of the yield curve. And I would say a lot of that has to do with growing concerns that all of this cutting of government spend could induce an economic slowdown or even a recession. And so that's also bullish for gold. Again, economic uncertainty, policy uncertainty, but also lower long end rates because the long end is competition for gold. It does have yield, unlike gold. So the higher that yield gets, the less tempting gold becomes. Seeing those yields come down as they are now, it's constructive for the yellow metal overall. So I would say that, we could see some choppiness, some sideways digestion of that upward move during today's tape. But overall, I remain constructive on that yellow metal. And if we zoom out, we could see there's not a lot of interest on the tape here, right? The biggest levels of interest are actually quite a bit higher and lower. One of them is at $3,000 an ounce, where there's 145 contracts on the bid or on the offer. And then on the bid, which was on my mind as I was scrolling over, just about 2845. You have 162 contracts. And just here we see a bit of an exhaustion event here, just a little bit of seller exhaustion coming into gold. It's a low confidence seller exhaustion print, but that comes with 433 stops and a stop run that just occurred on that GC contract. So you may get a little bit of stabilization and possibly even a bounce as sellers are getting a little bit ahead of themselves on gold. So folks, that's going to do it for me today. I hope you enjoyed this episode of Back to the Futures with me, Markets and Mayhem. And look, there's gold getting that little pop off the seller exhaustion. So it works. It works in a variety of different contracts. We also have this on crude. I'm actually going to put put an indicator out for gold eventually as well for this. But I think it's really interesting what's going on in the markets. Is de-risking. It's potentially a correction that's in the works. It's something to be careful about. Remember, wider stops, smaller position size, something to consider in a lower liquidity, negative gamma environment. Don't get killed trying to, trade this thing with too much size. You're just going to get chopped around. If you want to trade, consider smaller size and wider stops and be careful about execution here. And remember, the biggest thing in this environment, headline risk. At any moment, the president or one of his administration can come out and say something and it flips the script. Be aware of that and pay attention to headlines like you haven't before, because they matter a lot more for price discovery than they had during the last administration. So thank you all for tuning in. Appreciate you all. Catch you next week, Tuesday, 9 a.m. Eastern, for the next episode of Back to the Futures with me, Markets and Mayhem.